Welcome to the weekly update, where I'll go over the action in the market for Tuesday, January 17th through Friday, January 20th, and then we'll see how things look for the week of January 23rd through the 27th. Let's go back and talk about what happened. The scenario that the Fed might be getting ready to slow down their rate hikes, that was replaced this past week with the growth and rate hike concerns, and it seems like we go from one to the other. When we have growth and rate hike concerns, the market tends to go down. When we have this Fed slowing scenario, the market tends to go up. The beginning of the week, we had the slowdown scenario. Then kind of midpoint throughout the week, we saw some real weakness because the growth and rate hike concern scenario came to the forefront. And then on Friday, we saw a nice rally where things are slipping back more to the Fed might be slowing down phase. One report that came out was the PPI, the Producer Price Index, and it came in weaker than expected, and that was welcomed. The market liked that because the PPI tends to go hand in hand more with the CPI, but retail sales were also weaker, and that put some concerns on the markets, as well as some manufacturing data that came out, and that threw everything back more to the concern camp. On Wednesday, we saw a sell-off because they're assuming that the Fed is more likely to remain on its rate hike path, even though the economy is weakening. And on Wednesday, the S&P 500 lost its 200-day moving average, only to regain it again by 4 points on Friday. St. Louis Fed President Byrd, who's not a voter currently, said that he would prefer that the Fed stay on a more aggressive path, but also added the prospects for a soft landing have improved, but that really didn't have much of an impact on the markets. Another thing that's showing weakness going forward is building permits. Since you have to get a permit before you can start building, that tends to be a leading indicator, and they decreased for the third consecutive month. Then on Thursday, weekly jobless claims came out, and they were much lower than expected, and that produced some more concerns. And then Jamie Dimon, the CEO for JP Morgan Chase, said in an interview, quote, "I think there's a lot of underlying inflation, which won't go away so quick." And then he also went on to say that he thinks rates will top out at about 5%. We had earnings season. Stocks like Goldman Sachs, they really declined because their report wasn't well accepted. Morgan Stanley did fairly well. And then Netflix on Friday came out with their report, and that was well received. Friday ended up seeing a pretty strong rally, and the Nasdaq was able to recoup the losses that it had earlier in the week. Interest rates were down, and the dollar was also down, and that gave some support to stocks. Oil, after falling down below $80, is now back above at $81.69. And then the last point here is that we've hit the debt ceiling for the first time since 2011. Treasury Secretary Yellen notified Congress by sending them a letter saying that the ceiling has been reached and that the Treasury Department may need to begin to do something extraordinary to overcome that. And this is mostly a political game that's going on. We'll have to see how long they carry this out and if it has any impact on the market. Going back to the whole week, we were down 0.66% with the S&P 500, and volume was below average overall. The technicals, they're kind of mixed right now. I'll go through a lot of the charts and we'll try to figure out where we stand with that. But the market is really fixated on this inflation and interest rate scenario, whether it's positive or negative. If they think the Fed is going to slow down raising rates, the market goes up. If they think the Fed is going to stay on track or continue to increase rates, the market has a tendency to go down. Our trend is still weakening, and it's starting to drop below 20 on the ADX chart. We're in a trendless environment on the daily charts, and now we're starting to see that in the weekly charts. Here is how the week unfolded, where we had the shortened week due to the holiday on Monday. Tuesday, we did okay. There wasn't a really big change. We were up and then pretty much went sideways for a lot of the day. Wednesday is when we saw a lot of the weakness. We started off by doing pretty good, but then we hit some resistance and then spent the rest of the day going down, only to close at the low. Thursday, we gapped lower, but then didn't really go all that far after prices started trading here. We closed right down here at this support level. And then Friday is when we saw the really nice advance. We didn't have much of a gap at the open, but prices were pretty strong going into the close. So for the week, the Dow was down 2.7%. It's been the index that's been holding up fairly well. Not right now. The NASDAQ was up 0.6%. The S&P down 0.7%. Really, it's 0.66%. And the Russell 2000, which are the small caps, that was down 1%. Here is the performance going back to the beginning of the year, where the NASDAQ has been doing the best, then the NASDAQ 100, followed by small caps. All of the indexes are positive currently, even though the Dow is just hanging on to a gain. And then this is going back to the all-time high, where all of the indexes are down, showing that the NASDAQ 100 and the NASDAQ have really underperformed. Our sectors, this is looking at the week, how they performed, with communication being up the most. And we only saw 3 sectors that were positive. In addition to communication, we saw tech and energy. And then all of the other sectors were down, with the industrial and utility sector doing the worst. This is looking at the week, just for the sectors where the communication, which really got hit hard in 2022, as well as tech, well, they had a pretty good week this week. Energy is still continuing to hold up fairly well, but all of the other sectors were down. Looking at current market valuation, we're still looking at a fairly valued market environment. Not too expensive, not too cheap. Here's the overall score, showing that we're above the dashed line, so that's positive, and we're not up to this yellow line, which is 1 standard deviation above, and that's when we start to get overbought. Looking at the yield curve model, this is suggesting that we're strongly overvalued because we have an inverted yield curve. This measures the 10-year minus the 3-month. And I cover this pretty much every day in the daily videos. And we have an inverted yield curve right now, and that's negative for things going forward. The Buffett indicator, which takes stocks and compares it to GDP. We're also looking at the moving trend line here, the historical trend line. We're just a little bit below this 1 standard deviation. If we go above that, we would be overvalued. Right now, we're considered fairly valued because we're right below that line. The PE ratio is considered overvalued. We've gone above the yellow line, so we're getting above this 1 standard deviation here. The interest rate model is fairly valued. We're right here at the 0 line, where we had been negative for a lot of the time since the COVID plunge. Well, we're starting to come back more positive, but we're still fairly valued. Margin debt is considered to be undervalued. This goes back to the end of December. A lot of people really lost a lot of money in 2022, so they were not buying as much on margin, and that decreased the overall margin debt model. The S&P mean reversion model, this is probably the one that I refer to the most, just showing that we're not necessarily overvalued at this point. We have been going up, and we're still below the standard deviation. If we go above that, the market will be considered overvalued. And then this is a new one that they started posting. This is the State Coincidence Index model, and it just measures how many states have a decreasing state coincidence index. And once it gets to over 25, then it's looking like the U.S. in total is looking at a recession. Right now, we have a reading of 15. We did come up to this level earlier, but then we've been able to come back down from it. Looking at sentiment as of Friday's session, we're getting back over into the greed territory here, where we had been neutral after seeing a couple of down days. Well, with Friday's advance, we came back up to 59. And here is the historical chart showing how we had decreased, but now we're starting to come back up. So we can go with that. It's not an extreme reading. And here's the asset managers survey, just showing that they're at 65. We're kind of more neutral. When this gets 80 and above, they're getting extreme positive. When it's 40 and below, they're getting extreme negative. The latest reading of the RightX Bear Bull ratio shows that people are starting to get out of their bearish funds as the market's been going up, but they're still leaning towards the bearish funds more than when the market had been really advancing. Weekly sentiment survey from individual investors shows that after being extreme negative, they're starting to improve, but this was taken right after we had that good up week. Then looking at some Isabel Net charts, this is the investors that expect the S&P, where do they expect it to end? and 2023. A lot of them think it will be at 38.92. Well, between 3,800 and 4,000 is so far in the lead, and you can just kind of pause and look at this and see where people will think. This is just shooting in the dark. I mean, nobody really knows this for sure. And looking at sentiment, this pretty much goes hand in hand with the sentiment gauge that we're looking at, where we're tilted just a little bit more into the positive side. And then this is kind of surprising, where the net of percent that say they're overweight in stocks has dropped to a real low level. When we've seen other readings this low was in, of course, January 2023, back in September 2017, August 2010. And sometimes when we get a real low spike like this, then people start to come back in, and that helps give some support to the market. Those that think that the recession fears have peaked because we're starting to go up, thinking recession, and then it's starting to come back down. The thing that's really bothering investors the most is inflation, followed by a global recession, and that the central banks will stay hawkish, not only the Fed, but other banks in the world. The geopolitical events like Russia, Ukraine, the situation between China and Taiwan, systematic credit event, just some kind of a crash in the credit system or the bond market, and that there will be a resurgence in COVID. But inflation is still the number one concern. Those investors that have turned less bearish on growth after getting very bearish, it's starting to turn back up. So this could give some support to the market. This is looking at the AAI survey, just showing both the folks that are bullish and that are bearish. And we're getting with the green line to a pretty extreme negative reading. And this doesn't line up with the latest reading that we had. This is more from a week ago when they were pretty extreme negative. And a lot of times this can give some support to the markets. Looking at the economy, this is the spread between risky and non-risky loans. If this is really going up, that means that we're probably having some difficulty in the economy. Well, this continues to go down. And the financial conditions index, if we're below this black line, that means things are okay. We're below that and we are declining. When we go above that, that means that there are concerns. And then GDP, what are we looking at as far as forecasts right now? They're still predicting about 3.5% for GDP. Here's another look at this. According to Bank of America, we're looking at positive GDP for the fourth quarter and then in for the first 2 quarters of 2023 before we go negative. So Bank of America thinks that we're going to be hitting a recession later in 2023. This is every possible yield curve. When this gets really high, that means that it's predicting that we'll have a recession, and we're just below the 90 reading. If we go above this, that would just suggest that we are going to hit a recession. And then this is the path of the S&P 500, a soft versus a rough or hard landing. If we have a soft landing, we have this blue line here where we might decline, but then eventually we'll get back up to 3,600 in about 3 months. 6 months out, we'll be at 3,900, and we'll finish the year at about 4,000. If we have a hard landing, then we're going to decline much more down to 3,150 before rebounding up to 3,750. And at the end of the year, that's where they predict we will be. Just a shot in the dark with this. Then this is looking back in 2001. Even when they started to lower interest rates, this shows that growth stocks still ran into difficulty. So even if they start cutting interest rates, that doesn't mean that we're out of the woods necessarily as far as growth stocks. At the end of 2022, those companies that are looking to do a share buyback, that could be positive for stocks. Since if a company is willing to go out and spend its money on its own stock, that's considered positive. And then this is the probability of a recession in the next 12 months, starting to get pretty high. And the composite index, looking at the overbought, oversold, we're pretty much neutral, giving a reading of 66.6. And then the Empire State Manufacturing Index, it really came in low this past week with a really significant decline in its reading. The percent of those yield curves that are inverted, we're getting pretty high here. And when we see this real spike up with the inverted yield curves, quite often that marks a top in the market. And that's why we've been seeing a lot of pressure under stocks because of these inverted yield curves. And then this is kind of interesting, looking at the household debt to income ratios. And this just takes some European countries and then compares them with the U.S. And it's kind of surprising. The U.S. is actually doing about the best. They only are spending 100% of their income, where all these other countries have a pretty high debt to income ratio. Looking at real retail sales in recession, real just means adjusted for inflation. When this tends to flatten out and then start to decline, that's usually what happens before a recession begins. Looking at January, where we are coming into kind of the weaker part of the month, where historically later in the month in January has been more positive. Then the economic surprise index, these are the economic reports that came in to the upside, that did better than what economists had predicted. This has really been declining overall. And then looking at valuation against the Fed funds rate, this is more of a historical chart. You can just pause this and look at it if you feel that that will help you. This just talks about when different things have happened and then how the market reacted. And then this is privately owned housing units. When this tops out and starts to go down, a lot of times that is followed by a recession. And we're seeing a top and a potential really severe decline. So that may suggest that we're going to go into a recession. But there's other things out there that suggest that we're not going to go into a recession. Here's the VIX, where on the week we're still pretty complacent right now. There's not a lot of fear in the market as this is concerned. Now our equity put call ratio, that's suggesting something different. We're seeing where the VIX on a closing basis is declining and has spent a lot of the past week below 20 and even declining with the bar. The Ulcer Index, just a little bit to the underside of the midpoint, which is, this kind of lines up more with our sentiment, where the midpoint, that would be neutral. When we're under this line, that's positive. I know that's counterintuitive. When we go above this, since this is measuring fear, that means that we're typically going down. Looking at earnings and valuation, where according to the historical norms, using the Shiller PE ratio, which currently is at 29.05, that is considered to be overvalued because the median and the mean has been between 16 and 17. So historically, stocks are considered expensive. Then the FactSet blog post just says the S&P is now projected to report year-over-year earnings declines in both the first quarter and second quarter in 2023. And we can see these lines are just going down. And then another blog post says that S&P 500 earnings season update. Right here, over on the left-hand side, we have energy doing the best, followed by industrials, and then real estate, utilities, and then negative are all of the other sectors. Staples, the S&P itself, healthcare, tech, financials, communication, discretionary, and then materials. Looking at FedWatch, we're at 99.3% chance that they're going to raise interest rates 0.25% at the February 1st meeting. And here's the look at the balance sheet as the Fed is starting to get rid of those bonds that they purchased, especially during the whole COVID problem. Looking at breadth, we're seeing a little bit of improvement based on price and a positive divergence here, and a little bit of an improvement based on volume. We're still looking okay with the 19 and 39-day exponential moving averages, so our advanced decline ratio is continuing to advance. And the new highs, new lows, still looking positive on the 4-week, starting to turn up more on the 10-week. Accumulation distribution looking more positive with the line above the moving average. Our trend, we can see the ADX is really starting to come down, has now dropped below 20. That means that we're more in a sideways market. And as I mentioned before, the daily chart is also in a sideways market. Looking at the Arun, nothing new to really tell us here. We're seeing selling pressure and buying power both decreasing. Overall, it's flatlining, but it's below zero, so it's more negative. The mass index not giving us a signal currently. Long term, this first, I know this, I say long term and then I show you a daily chart. This is just kind of a launching point where we came back up in Friday's session. We closed just a little bit above the 200-day moving average. We have this declining trend line here that has been really problematic for the S&P 500. Are we going to be able to break through that, or are we going to turn and go back down? Are we going to give this another try? If you had asked after Thursday's session, it looked like we were going lower. But then we had a real nice bounce on Friday. We might be able to give this another shot. But then can we close above that? And then on a weekly chart, can we stay above that? Our trend channel shows that we're just about at the midpoint currently. And pivot points, we're coming right up to the underside. This is also where this pivot point is also where that trend line is. And we're still below the 50-period simple moving average on the weekly chart. Long term, we're still showing a negative trend, but it could be improving. If we could break above this red line and then stay above it, we would potentially see a golden cross. And the bullish percent index is above 50 and advancing. So even though it declined this past week, it's still positive overall. The Chaikin oscillator, long term, looking positive. It's above the dashed line and advancing. Chaikin money flow, also positive. The force index, even though it declined, is still above 0 in green, so that's positive. McClellan oscillator starting to come down after giving an extreme positive reading, but it's still above 0. Summation index based on price is advancing and above 0, and volume is advancing and above 0. So that's positive. And then looking at our different oscillators, the slope and TSI are positive. That's short term. Then intermediate term, we have the MACD, PMO, and PPO. Those are all positive. And then our longer term oscillators are the TRIX and the KST. So right now, all of these oscillators continue to be positive. Swinland trading oscillator based on price and volume is declining and below 0. That's a bit of a warning sign. The PMO continues to go up as I showed a couple charts ago, and we're advancing based on price as well as volume. Our PMO study shows that we're declining with those rising PMOs. The buy signals are declining, and those PMOs that are above 0 continue to advance, not giving us any extreme readings currently. The RSI going back 14 weeks is above 50, so that's positive, but it did decline this past week. The special K continues to be positive, even though it's been declining. Stochk RSI, after giving an extreme positive reading, has now dropped down. And the Williams percent R, same thing. Extreme positive and has since dropped back down. The vortex continues to be positive with the green line above the red line. And the green line is advancing as the red line is declining. The ultimate oscillator, even though it declined this past week, is still above 50, so it's positive overall. The money flow indicator dropped below 50 and is declining, so that's negative. The Bollinger Band's pretty much neutral right now. We really pay attention to this when we go above 1 or below 1, and we're not giving either reading currently. The rate of change going back 1 week shows that we're pretty much neutral because on a Friday to Friday basis, we didn't see that big of a change. And going back 50 periods, still looking a little bit more positive after forming a bottom in October, but we did decline over this past week. The Copic curve is giving a buy signal on the weekly charts. We're also working off one on the daily charts. Here is the weekly chart showing that we're above both of the moving averages, and they're starting to come together. If we can break up out of this, this could be a golden cross and be very positive for the market. If we fall, we have support at about the 38.12 level, and then below that would be this 200-week moving average. Looking at our different charts, the Heikin Ashi has been positive for the last few bars. The Kegi continues to be positive. The Renko is positive. The ease of movement, 1 week is declining but still above the midpoint. Going back 14 weeks is still advancing. Nothing new on the point and figure chart, and no signal has been generated. The 3-line break is more negative, where we're seeing some recent weakness. Looking at the Elder Impulse, we are positive for the S&P 500. We're positive for the parabolic SAR system. Looking at the 3 different indexes, here's the S&P, here are the mid caps, which have been really performing better on a relative basis than the other indexes, and then small caps, which have also been performing better. So this could give some support to the market. All stocks, on the daily chart, we're starting to see a golden cross, but here on the weekly chart, we're seeing a lot of improvement, but it hasn't crossed over, at least yet. The mid caps could be getting ready to produce a golden cross. We're seeing one recently on the daily chart. The same thing with small caps, could be getting ready for a golden cross, and we have had one now on the daily chart. The Dow is still giving us a golden cross. It's positive both on the daily and weekly charts. The NASDAQ continues to be negative. Same thing with the NASDAQ 100. The Wilshire showing some improvement, but still negative. The NYSE giving us almost a golden cross. And the FANG stocks still have a lot of making up to do, as does ARK. The 30 biggest U.S. software companies showing some improvement here, but still negative. And then looking at Dow theory, where we're not really seeing much of any kind of divergence or convergence between the Dow and the transports. The utilities, after really spiking up, they've been doing okay. The CRB index giving us a recent death cross, and it's now in a downtrend. Copper really has been bouncing up, and this could be positive for the economy. When copper goes up, that tends to suggest that the economy will be doing better in the future. When it goes down, the inverse of that is true. So we're getting a prediction on a lot of fronts that there will be a recession, but we're seeing copper here really start to do well and has actually given us a golden cross on the daily charts. And if it continues to go up, it'll give us a golden cross on the weekly charts. Gold has given us a golden cross on the daily chart, getting ready, if we can stay above these moving averages, to give us a golden cross on the weekly charts. Here is Goldman Sachs' projection of gold, currently about at 1879. They think it'll fall down to 1850 before going up to 1950. Silver giving us a recent golden cross, so that's turning more positive. Oil is back a little bit above 80 at 81.64. Here's the dollar, which continues to show weakness, which has been giving support to stocks. And here's the euro against the dollar, where they think that it will decline down to the euro being at 102 before it gets ready to bounce back up to $1.10 to 1 euro. Looking at bonds and interest rates, here's the bond ETF. Really seeing a lot of improvement on the daily chart, seeing some improvement here on the weekly chart, but not a golden cross yet. Here is the MOVE index, which is the VIX for bonds. Still not necessarily a lot different than what we've been seeing as far as volatility. Here are interest rates. This is a daily chart where we spent a lot of the week declining in interest rates. Friday, they turned back up. And then internationally, this is a weekly chart showing how the US, UK, and German rates, after really going up, are starting to come back down. And then Japan's kind of its own little story. And relative studies, looking at the intermarket analysis, still going back to the end of 2021, oil has been doing the best, followed by the dollar. Gold is starting to show some improvement and could be getting ready to overtake the dollar, where stocks and bonds continue to be negative. Then looking at the bond to stock ratio, nothing really severe here, but we are just slowly seeing some improvements in the bond market. This is one of those where you have the stock to bond ratio, where stocks have been really outperforming bonds. Even though stocks have really suffered, bonds have suffered even more. Well, that's starting to come back down. And then gold to the US dollar shows that gold has been going up when compared to the US dollar. And then gold to the S&P 500. Gold has been outperforming the S&P. And low volatility to the S&P 500 shows that these stocks still are continuing to do better. And they hold up better when we're having a lot of uncertainty in the market. And then the growth to value ratio is still in a downtrend where growth is underperforming value. The NASDAQ 100 continues to underperform the S&P. The S&P 100 continues to underperform the S&P 500. And discretionary continues to underperform staples. Energy is still outperforming tech. What is our outlook then for the upcoming week? On Monday, we have the leading economic index coming out. There's nothing on Tuesday. Then on Wednesday, there'll be the MBA mortgage applications index. Then on Thursday, we get GDP. That's going to be a biggie. We get durable goods and jobless claims. And then the advanced international trade in goods, advanced retail, and advanced wholesale inventories. New home sales will be coming out. So the big week this week will be Thursday. Then on Friday, we do have an influential report, personal income and spending and PCE prices, pending home sales, and consumer sentiment. So later in the week, there's going to be a lot of data coming out. So the technicals, we're still holding in there. Okay, the improvements that we were seeing in the weekly charts are still looking pretty good right now. We need to see some more positive things to redevelop in the daily charts and then have them come over into the weekly charts. The market's still really fixated on the inflation and interest rate scenario and then any Fed speak that we may get. So looking at the Stock Traders Almanac for January 23rd, that's as far out as I go with this, just on Monday, it's down on the Dow 66% of the time. It's only up 33 1/3%. Little over half of the time it's up or down with the S&P, and it tends to be more negative with the NASDAQ. And then we're also looking at the Januaries over the last 23 Januaries. They've declined 56.5% of the time and been up about 43.5% of the time. Then we're still in that November, December, January window for things looking fairly good, being positive seasonality. And then on a yearly basis, we're still waiting for the end of January to come to get our January barometer. We had the Santa Claus rally, which gave us a score of 1. Then the first 5 trading days were positive. That gave us a score of 2. Then we'll see what happens at the end of January. Then the markets also really like that we're split between Republican and Democrat in our government, because then that tends to bog things down. Then this is just another look at some of the stock market almanac statistics. I also showed this in last week's video. We don't have anything yet. We're waiting for the January return to come in to see what will happen. Our scenarios can't really go with the down scenario because we're not trending either on the daily charts or on the weekly charts. Even though our technicals are turning more negative, Friday helped to recoup a lot of that negativity, but we need to see follow through on Monday and through this coming week. We can't really go with the up scenario either. We're still going with the sideways trend because the ADX is weakening both on the daily and weekly charts. It's below 20. It's more negative on the weekly chart, but it's still positive on the daily chart. Thank you. Have a wonderful week. I also have the daily brief that I post each day. I also have the intermarket analysis video as well as the deep dive where I look at the other charts that I don't really cover in the videos because they're not necessarily telling us anything, but it's still helpful to look at those charts. Have a great week, and I'll talk to you in the next video.